Hi class. In this lecture, I'm going to talk about everybody's favorite topic, income tax. The money you have to pay the federal government based on how much you earn. All right, so in this lecture, we have some objectives. And what I want to do is I want to talk about how you determine what's considered gross income, adjustable gross income, and taxable income, because they're all not the same thing. And, this is actually really important to know as you get out of college and start earning more money. Then we want to calculate some federal income tax. We want to calculate what we call FICA taxes. Those are your Medicare, Social Security taxes that you pay into and with every paycheck. And then I want to solve problems involving working students and taxes. So we'll actually do some people's tax returns, like how much they would have to pay in federal income tax. Okay, so what is income tax? Income tax is a percentage of your income calculated by the government to fund its services and programs, like how we pay for the military, how we pay for Medicare, Medicaid, Social Security, things like that. How we pay for federal government employees' salaries. This all comes out of income tax. All right, so how you calculate income tax? Well, what you actually need to determine to do such is what's called your adjusted gross income. So adjusted gross income is equal to your gross income. This is like all the income you earn for the year, minus what they call adjustments. These includes payments to tax-deferred savings plans. Like if you have a retirement plan and you contribute money into that, that does not get taxed. Then you need to, once you have that figured out, your adjusted gross income, then you need to determine what is your taxable income. And now your taxable income is equal to your adjusted gross income. So like the money that you have after you put away for savings. And you subtract away what they call exemptions and deductions. And now exemptions are a fixed amount for yourself. It varies by year and is the same for each dependent, like any children you have. Deductions. Now, when you take a deduction, you have two choices. You could take what's called the standard deduction or an itemized deduction. So a standard deduction is just how much money everyone's allowed to write off from their adjustable gross income. But some people have more money that they have spent that can be deducted from your taxes, and that goes into what's called itemized deduction. Now, this includes a bunch of things, like interest on home mortgages. Like, for example, I have a mortgage, so the interest I pay towards my mortgage, I can deduct from my taxes, state income taxes, property taxes, charitable contributions, and medical expenses only exceeding 7.5% of your adjusted gross income. So, like, for example, suppose someone makes $100,000 and they spend $5,000 on medical expenses. Well, they can't deduct that because that $5,000 is not greater than 7.5 of their adjusted gross income. All right, so then the way you determine your income tax is you take your tax computation, which we'll do. So we'll use taxable income and tax rates for your filing status to determine this amount. We will do that for somebody, and you subtract away what we call any tax credits. And so this may include up to $1,000 per child, the cost of childcare so that a parent can work, other things like adoption credits for qualified expenses. For example, I have a kid at home. I can, after I figure out how much income tax I have, let's say I have to pay $15,000. I don't know, I'm just making that up. If I have to pay $15,000 in income tax, but I have a child at home, I really only have to pay $14,000. That's what that's saying, because I get a credit for my child. All right, so let's talk about this difference between the gross income, the adjusted gross income, and the taxable income, just so you can see the difference. So a single man earned wages of 46,500. Okay, so that's how much he made in that year. He received $1,850 in interest from a savings account. That's pretty good. He received $15,000 in winnings on a television game show. That must be nice. And he contributed $2,300 to a tax-deferred savings, right? So he is entitled to a personal exemption of $3,800 and a standard deduction of $5,950. However, the interest on his home mortgage was $6,500. He paid $2,100 in property taxes, $1,855 in state taxes, and he contributed $3,000 to charity. Oof. Okay, so I want to determine the man's gross income, the man's adjusted gross income, and the man's taxable income. Okay, they're all different. I know it seems confusing. All right, so as we go through this, what it helps to do actually at this point is like pause the video and on a sheet of paper, like write everything out, what it is and how much money was spent on it so you can see where I'm putting it. Okay, so the gross income. All right, so the gross income refers to the person's total income. So this includes wages, interest from savings account, and that game show winning. So this was his wages, his interest, and the game show winnings. So actually, this man's gross income was $63,350. Okay, so that's like how much, that's just how much money he made that year. All right, so to determine the man's adjusted gross income, so adjusted gross income is gross income minus adjustments. So the adjustment in this case is how much money the person contributed to his tax deferred savings plan. So that is $2,300. So you're going to take that and you're going to subtract it away from the $63,350, and the person's adjusted gross income is $61,050. All right, now the person's taxable income, okay? All right, so we need to subtract exemptions and deductions from the adjusted gross income to determine the man's taxable income. Okay, this taxpayer is entitled to a personal exemption of $4,050 and a standard deduction of $6,300, okay? So, however, the thing about this is that the man's you can either take the standard deduction or the itemized deduction, okay? So you can't take both. So if you look at the person's itemized deduction, so that would be the interest on the mortgage, the property taxes, the state taxes, and how much he contributed to charity, that adds up to $13,455. Okay, so that right there um, is how much his itemized deduction is. So he's not going to subtract the 6,300. He's going to subtract away his itemized deduction. All right, so the person's adjusted gross income is his exemptions plus his deductions. So you take his adjusted gross income, okay, which was $61,050. You subtract away the exemption that the man is allowed, okay, and I'm sorry for the typo here. Here it's 3,800, but that's the actual exemption. So minus $4,050 plus his itemized deduction, so that $13,455. So the man was able to write off his taxes, $17,505. You subtract that from his adjusted gross income, and you get this number. So this man's taxable income, how much he would have to pay taxes on, is only $43,545. So he doesn't have to pay taxes on this amount. He pays taxes on the amount after he takes away his exemptions and deductions. Okay, so the table next shows the tax rates, the standard deduction, exemptions for the 4 filing status categories. So if you're unmarried, divorced, or legally separated, you're single, these are the tax rates you have to pay. So for example, you pay 10% on the first $9,275. Now this is important. If you go to the next tax bracket, you'll see 15%, and it goes up to $37,650. Okay, you don't have to pay 15% on all $37,650. You only have to pay 15% on the money earned between these two numbers. You pay 10% on everything less than this, 15% on any dollars you earn between here. You get up to 25% on anything in between here, 28% here, and so on. If you're married but filing separately, you can see the following tax brackets. If you're married but filing jointly, you can see the following tax brackets. And if you're the head of household, when you're supporting somebody else, you can see the corresponding tax brackets. These are the standard deductions, and you got to forgive it. These standard deductions are actually previous towards the tax law that changed last year. And these are the exemptions that a person's allowed to take. Okay, let's actually right now do somebody's taxes so you can see how this is done. All right, so let's calculate the income tax owed by a single woman with no dependents, all right, whose gross income adjustments, deductions, and credits are all given here, okay? So let's use the marginal tax rate from the table. Okay, so this single woman with no dependents, she has a gross income of $6,200. She has an adjustment of $4,000, and she has a tax credit of $500. All the way on her right are all her deductions. So she has mortgage interest of $7,500, property taxes of $2,200, charitable contributions of $2,400, and these are some medical expenses not covered by insurance. It's $1,500. What you should immediately notice is that that $1,500 is not greater than that 7.5% I said. So she will actually not be able to write off the medical expenses. Okay, so let's determine the adjusted gross income. So the adjusted gross income is her gross income minus any adjustments. Well, if you look back, she made $6,200. She had an adjustment of $400. So $6,200 minus $400. Her adjusted gross income is now $58,000. Okay, so now that's where we start looking at how much she's going to have to pay taxes, but we have to subtract away next all her deductions. So to determine her taxable income, you take the adjusted gross income and you minus the exemptions plus the deductions. So where does this, first off, this $4,050 come from? If you go back and look at the table, a single person has an exemption of $4,050, so I immediately get to write that off. The next thing is we got to figure out what her deductions are. Well, we have the mortgage interest, the property taxes, the charitable contributions, but she cannot write off the medical expenses because that medical expenses would have to exceed $4,350 for her to write it off. So this plus this plus this gets a total of $12,100. Okay, so that's how much she's able to write off her adjustable gross income. So we're going to substitute $12,100 into the deductions part here, right? Because that's greater than the standard deduction. And we'll see that her taxable income, okay, you take the $58,000, you end up subtracting off $16,150, and her taxable income is only $41,850. Okay, so the next thing we have to do is we have to determine how much this woman has to pay in income tax. Well, the income tax, we have to figure out the tax computation, how much she actually owes in taxes minus any tax credits. Well, if you look, the problem said she had $500 in tax credits. So how much ever she has to owe in income tax, we're just going to subtract $500 from it. So since the single woman's taxable income is this amount, she falls into the bracket of the 25% tax bracket. So let me go back and show you. All right, so do you notice how $41,000, her rough income, falls between these two numbers? That means her top marginal tax rate, her top tax rate she has to pay is 25%. But now this is important. She doesn't pay 25% on all her income. She only pays 25% on the monies she makes between these two numbers, 15% on the money she makes in here, and 10% on the money in here. Okay, so here's what happens. She pays 10% on the first $9,275 of her taxable income, 15% on all her taxable income in the next tax bracket, so everything between $9,276 and $37,650, and then she pays 25% on her taxable income above that $37,651. Okay, so this is how you would do it. She pays 10% of the first $9,000 she made. Now she has to pay 15% all the way up to $37,650. However, she already paid taxes on that $9,275, so we subtract that away. Then she needs to pay 25% up to her final salary right there. However, we subtract away, she's already paid taxes on this much money, on $37,650. So after you do the subtraction amounts, She paid 10% on the first $9,275 she made. She pays 15% on this minus this. She pays 15% on that much of her income. And then this minus this, she pays 25%. This minus this ends up being $4,200. So just multiplying each of these, 10% of $9,275 is this amount. 15% of this is $4,256.25. And 25% of this is $1,050. If you add all these up, this woman would owe $6,233.75. So we substitute this in for the tax computation in the formula for the income tax, but we subtract away $500 because she had a tax credit. So she would but she would owe $5,733.75. That's how much she's owed in income tax. Okay, so in addition to income tax, the thing is we're required to pay what's called federal government FICA, which is Federal Insurance Contributions Acts. This tax are used for like Social Security and Medicare benefits. So we know what Social Security does, right? Social Security provides payments to eligible retirees, people with health problems, eligible dependents of deceased persons, and disabled citizens. And Medicare is the health insurance program for Americans over 65 years of age. Okay, so here's how the FICA is determined. You have to pay someone on their salary, you have to pay 7.65% on the first $118,500 of income you have. And then after you go over that, you only have to pay 1.45% of income in excess of $110,000 on your, excuse me, that's a typo, on $118,500. Employers have to match how much you pay as well, so they have to match exactly the same thing. And if you're self-employed, you have to pay 15.3% actually on the first $118,500, and then you have to pay 2.9% of everything after that. So it's a bit not great. You have to pay basically your employer's rate and the matching rate yourself towards this. Okay, so let's suppose you are not self-employed and you earn $150,000. Okay, must be nice, right? What do you have to pay in FICA taxes? Okay, so the tax rates are 7.65% on the first $118,500 of income and 1.45% on income in excess of that. So how much you have to pay in FICA taxes? Okay, you change this to a decimal, so you take 0.0765 times, well, you made 150,000, so on your first 118,500 plus. Then you take this 1.45%, change it to a decimal, you get 0.0145. You multiply that by, well, you made 150,000, excuse me. But you have to subtract away the money you've already paid taxes, okay, because you don't have to pay double taxes, right? So 150,000 minus 118,500 ends up being 31,500. So you multiply as shown here on the slides. This times this gets you this amount. This times this gets you this amount. So this person who made $150,000 has to pay $9,522 in this FICA tax. Now this is on top of the federal income tax they have to pay as well. All right, let's talk about an example for taxes on a working student. Okay. All right, so you would like to have extra spending. Okay, so let's just pretend you decide to work part-time at your local gym. The job pays $15 per hour and you work 20 hours per week. Okay, your employer would hold 10% of your gross pay for federal taxes, 7.65% for FICA taxes, and 3% for state taxes. Okay. Let's go through all the following. What is your weekly gross income? How much is withheld for federal taxes? How much is withheld for FICA taxes? How much is withheld for state taxes? What is your weekly net pay? And then finally, what percentage of your gross pay is withheld for taxes? All right. Well, first off, what is your weekly gross pay? Well, you're working 20 hours a week, you're getting paid $15 an hour, so you're getting $300 a week as your gross pay. But like, you're not getting that amount in your paycheck. So how much is your paycheck? So the federal government keeps 10% of it. So you take 0.10, multiply by 300. The federal government keeps $30 of your paycheck. Right? How much is withheld per week for FICA taxes? Well, FICA taxes were 7.65%. So multiply that by the $300 that you're making. Sorry for this other typo here. So 0.0765 times 300 gets you $22.95. So that's how much withheld in FICA. How much is withheld per week for state taxes? Well, state taxes, you take 3% of $300. 3% of $300, you end up paying $9 in state taxes. So what is your weekly net pay? Well, it's the $300, and you subtract away all the taxes you have to pay. So adding up the federal, the FICA, and the state, you get 300 minus $61.95. So your actual pay, how much you're going to see in your paycheck is not the $300, but $238.05. Okay, so what percentage of your gross pay is withheld for taxes? Well, take the amount you pay in taxes. Okay, all right, that's how much of your income is getting paid, withheld for taxes. Divide that by your $300. This divided by $300 is 0.2065. Okay, so changing that to a percentage, federal government is keeping, even though you're only working part-time, around 20.7% of your income, right? And it's using it to fund all the federal programs, Social Security, Medicare, so on.